So guide us through this maze, Katie. What happened this week exactly? Were the markets really that disappointed in what the Fed had to say? It basically said what it said it was going to say, didn't it?
Yes, I don't think the market necessarily was disappointed in what the Fed had to say as a driving force behind the volatility. I think it's a confluence of things, David. I mean, we are in a period of time in the calendar year, which is typically a little bit tough for stocks in general. And then we've got all of these cross currents of news on the pandemic, some of it not so great. So I think markets are in this digestion phase of figuring out what's next. And I think the situation in the picture looks a little bit murky at this point.
Well, let's talk about that combination, actually. On the one hand, is it sort of falling out of love a little bit with tech, saying, oh, we've gone far enough with that, we need to go back to cyclicals? And by the way, you mentioned the pandemic. Are people saying maybe we're a little more hopeful about vaccines or something coming out of the pandemic that will get us past this?
Right. Of course, the news on the vaccines has generally been really positive. I think the timing, though, still remains a question. We know it's going to be a when, not if kind of scenario, but whether it's in the first quarter, whether it might get pushed to the second quarter, that means something to the markets. Now, in terms of the rotation, there does feel like there's a desire to really rotate out of the mega growth stocks and more into value stocks, but it's tentative. We didn't see a massive outperformance over the last couple of days. It kind of felt more tentative to me. So I think unless we have real visibility into the economic future, which is really going to depend on the pandemic, it's going to be hard to have a real durable rotation out of growth and into value. I think the tech stocks, frankly, are just due for a correction. And that's what we're seeing as investors are taking some chips off the table here and booking some really nice profits.
Well, it's nice to take the profits. The question is, what do you do with those profits? And if you're really putting together a portfolio right now, what do you do? Historically, you'd say, well, let's put 40% into bonds. But at this point, you can't get the yields much lower than they are right now. So the bonds can't go too much higher. So where do you go to really hedge?
I mean, unfortunately, there's no great answer to that question. There's no satisfactory answer, I should say. The fact is, we still think cash and bonds provide a hedge to portfolios. The problem is you're not going to get much return. So it feels in a lot of ways like a relatively expensive insurance policy. So what we're advising our clients and what I would advise all investors to do is just make sure your bond portfolio is right-sized. Don't be over-allocated to fixed income right now because, as you rightly referenced, the upside from here is very limited, to say the least. But you do need fixed income and cash to provide you that buffer to fund goals, near-term high-value goals that you may have over the next couple of weeks and months. But you don't want to have too much in fixed income.
Okay, so does that push you out sort of, if I can call it the risk curve a little bit? Say, let's take some more risky bets here because we got to put it somewhere and we want some sort of return. It's hard to get it from fixed income and maybe we don't believe equities will be at least a steady return going forward.
Well, I mean, you have to have the right time horizon, David. So if you're invested in equities, you've got to have a long-term time horizon, especially given the headwinds that we see over the next couple of weeks and months. We have, in addition to the bobbling news about the pandemic, whether it's positive news on the vaccine front, perhaps negated somewhat with rising case counts, certainly in Europe and even in the U.S. to a certain extent. So we have that near-term volatility. We have the election clearly, which is going to drive a lot of market volatility. So if you're invested in equities, you got to have a long-term perspective. One area, though, that we continue to see value is in high yield. So you're creeping out on the risk spectrum, certainly, and we consider high yield to be a risk asset and not a risk control asset. But that said, you're still getting, a 5% kind of return. And we think that default rates actually are going to be falling into 2021 and beyond. So it's not a bad return relative to what else is out there right now.
You mentioned the election. How do you play the election as a practical matter? We're starting to see it in some actually parts of the market that people are really starting to price in at least increased volatility, particularly if we don't get a firm answer on November 3rd, which at this point seems very questionable.
Oh, I think we absolutely have to expect that we won't get an answer on election night, as we're used to. The very high volume of mail-in and absentee voting is going to make that an impossibility. So I think we have to be prepared. we have to be prepared to withstand perhaps an extended period of excessive market volatility to the extent that we have an undecided or even a contested election. Now, we've been there in the past, and we know that markets don't like uncertainty. And so we see that markets do sell off in the face of that kind of uncertainty. And we have to expect that, which again kind of comes right back to your original question about bonds, cash and bonds and portfolios. That's really why you want to own cash and bonds, because we do think that that will provide you a great diversification benefit in the event that we do have some volatility coming into and then post the election period.
Katie, in a word or two, are your clients, are investors being reasonably patient right now, or are they very angsty?
Well, I think investors are being patient, but I do think that there's growing anxiety around the election, David. Investors are very concerned
Right.
about how this will break
Right.
from a tax perspective or regulatory
Right.
perspective. You were just talking
Okay.
about China earlier. So there's a lot at
Katie,
play right now.